You have probably heard of the 100 minus your age thumb rule of asset allocation. This says that if you are 30, you should have 70% in equities and 30% in debt. And for that 70% equity, we are extremely careful. We slice it across large cap, small cap, mid cap, index fund, and even thematic funds and whatnot. The thrill of stocks, the compounding power of mutual funds, it's exciting. But here's the hard truth. Most people can't build a portfolio with equity alone. One also needs debt to balance. Unfortunately, when it comes to the other 30%, the debt side, most investors either dump it in a fixed deposit or worse, ignore it completely. And that's a mistake. Because debt is not a monolith. Debt comes in many flavors, each suited for different needs. Parking idle cash, funding near-term goals, or creating stability in your portfolio. So, in this video, let's decode debt. By the end, you won't just know the types of debt funds, you will know how to match them with your own real-life situations. Before we begin, let's quickly understand what a debt fund is and how it functions. So, the companies borrow money by issuing bonds to fund their day-to-day operations or even long-term projects. And debt fund invests in these bonds. The bonds often pay a regular rate of interest to the mutual funds and pays back the principal at the end of the predetermined period or maturity. Now, coming to the categories, number one is overnight funds. If you have money lying in your savings account for just a few days, say you are someone who wants to park for a few days with negligible risk, or you are dipping your toes into the mutual fund world and making a first transition away from the bank account, an overnight fund is better. It invests in securities that mature the next day. Risk is virtually zero, returns are slightly above saving bank's account. Think of it as a safe parking lot for your cash. Next are the liquid funds. Let's say you are saving up for your child's school fees due in 2 months, or you want to park your bonus till you decide how you want to invest. A liquid fund works well here. They invest in up to 91-day instruments, making them perfect for a short parking with better returns than your bank. Now, while liquid funds are among the most easily accessible debt categories, it's worth noting something called liquidity risk. The risk that the fund may not be able to sell its underlying securities quickly enough if there's a sudden redemption pressure. It's rare in well-managed liquid funds, but it can show up during extreme market events. At number 3, we have ultra short-term funds. Suppose you have planned a vacation in 6 months. You don't want to risk equities for such a short horizon. But you also don't want money lying idle earning just 2.5 to 3% in your saving bank's account. Ultra short-term funds with maturities of about 3 to 6 months are ideal for such goals. Slightly more volatile than liquid funds, but the returns compensate. Next are the short and medium duration funds. Think of a 2 to 4 year goal. Maybe you want to buy a car or saving for a big wedding. Here, a short and medium duration fund are a good fit. They invest in securities with majority ranging from 1 to 4 years, and you get stability, decent returns, and manageable risk. At number 5, we have dynamic bond funds. This one is like giving your money to a fund manager who actively plays interest rate cycles. For example, if they expect RBI to cut rates, they will buy long-term bonds to lock in those higher prices. But if the rate rises, they shorten the portfolio. Great in theory, but here you are betting on manager skill. Suitable if you don't mind variability. Next are the corporate bond funds. These funds invest in top-rated companies, think Reliance, HDFC, Infosys, etc. If you are someone who would normally put money in fixed deposit, corporate bond funds can be a smarter alternative. Safer than credit risk fund with slightly better returns than FDs and more tax efficient if held longer. At number 7 are the credit risk funds. Imagine lending to a smaller or low-rated companies. Risky, right? But because of that risk, they offer higher yield. If you are an aggressive investor who already has a strong equity portfolio and you want to add high-yielding debt for diversification, credit risk funds could be a good fit. But for most average investors, this is not their first choice. Next are the banking and PSU funds. These are relatively safer because they invest in bonds issued by banks, public sector undertakings, or government-backed institutions. A good option if you want safety with slightly better returns than liquid or short-term funds. And lastly, we have Gilt Funds. These invest only in government securities. The good news, no default risk, because the government almost never defaults. The catch, Gilt funds are extremely sensitive to interest rate changes. If you invest here, be ready for volatility. For example, if RBI cut their rates, Gilt fund can give you double-digit returns in a year. But if the rates rise, they can fall sharply. For short-term Gilt funds, there is more stability, low volatility. But for a long-term Gilt fund, highly sensitive, suitable only for investors who understand the interest cycles. Here is a quick summary of what we discussed. Equity is the engine of your portfolio, but debt, that is the seatbelt. It may not feel exciting, but it keeps you safe during turbulence. So the next time you hear someone dismiss debt as boring, you will know better. Because in investing, boring is often beautiful. I hope you like this video. See you in the next one. Until then, happy investing.